down from 9.1% in June. The CPI measures a range of prices from gas, groceries, cars, furniture, to name a few. The report suggests inflation pressures are easing somewhat, but still remain near their highest levels in 40 years. The Fed has already raised interest rates, and economists have expressed concerns of a recession. Wages have increased 5.2% from last year, but housing and food prices are still rising at a pace faster than wage growth. So it's not taking the sting out of inflation. I want to bring in David Struzeski, CEO of Sound Planning Group. David, thanks for being here. What do you attribute the ease in inflation to, and has it peaked?
Great question. Great being with you. What is going on right now is very interesting. So there's two ways to take inflation down. We obviously know the Federal Reserve can raise rates, and ultimately that actually hurts us as consumers. That's the goal, is to actually destroy demand. The other way is that we could increase supply. So why is there a big rally here today? Well, candidly, the bulls really want to run. We had a wonderful jobs numbers come out here last week with some real wage inflation, although when we see the real inflation relative to the 8.5 that we know is here, we're actually still going backwards. But as we look at these things, it's important to understand that we really haven't addressed the supply side of these particular problems here. But the CPI continues to burn and burn. So, is everything over? I don't think it is. I believe that we're probably going to see a 50 basis point rate hike here in September when the Federal Reserve gets back together. I do think that they're probably not going to do the 0.75 like previously, but we've got a number of things that they're looking at, and food prices are something that everyone has to continue to buy. So though there was a zero increase across the board, we can see inflation still going up in food, still in gasoline, although gasoline has come down a little bit. One of the reasons why I believe that the gasoline has come down is not because we're producing more of it, which would be a good idea, especially because Europe needs a bunch of it and natural gas as well, but because we're just consuming less. And so I believe that people are beginning to change their buying habits. And I believe that the consumer right now today is kind of preparing for some of this. So I believe today's news is a little bit of a surprise, but an expected one at that.
Right. The demand for gas is down, no doubt. And that's probably because wages are still not keeping up with inflation. Americans are still paying more for essentials like rent, food. So what does this mean for the average family?
The average family has less money today than they did last year or the year before. I believe that people need to be very smart right now and look at their personal budget. I think that it's very important for the average person today to actually also look at their portfolios. If there's ever a time to do it, people are talking to us about two different things right now. That's either, they want to avoid risk or they want to fight inflation. But those are completely different investment strategies. So the Fighting Inflation group are having an amazing day today because the market has turned on and equities are really running. That is amazing. The folks that are trying to just fight risk, though, unfortunately, there are more challenges ahead for us because bonds, who have been the go-to for so many years, are not working as they are correlated differently here than the stocks are. And they're actually suffering with these rate increases. So our goal when we invest is to ride bulls and tame bears, and the average person has a real challenge in doing that right now.
Okay, so the CPI follows a stronger than expected jobs report as well, with more people working full-time jobs, right? So White House officials continue to say we're not in a recession. Look at the strong jobs market. What's your analysis on that?
Yeah, I think they're probably spiking the ball today about all of the above, and to use a football term. But here's the point: of the 500,000 jobs that were added, approximately 400,000 of them were part-time workers who became full-time. So those were not new positions that had someone fill them from just an ad placement. These are people that were already there, and then now they've been ranked up as we recognize that we can take on more full-time employees. So businesses today are still having a lot of challenges in getting new employees. In fact, I was just on the phone with somebody who is trying to outsource right now to India, South Africa, or the Philippines. And I was thinking to myself, we need American jobs. We need people, getting back to work and making this thing happen here at home. But unfortunately, you got to go where the opportunities are. So, the average person here today is looking at a weaker economy. And I think Jamie Dimon had it right, if I can use this analogy. There's a difference between tornadoes and hurricanes. Tornadoes show up and we have this crisis event. A hurricane, though, is something that develops in the distance. We see it. We can name it. It becomes stronger and stronger. There's a glide path that we recognize is going to touch different places. And then ultimately it gets there. And so in our case, we've got incredible deficit spending that's happened. I mean, over $8 trillion in 2 years in the first part of this administration. We've had policies that have unfortunately hurt us in our oil production and energy production. And I'm just going to note this again, because this is a really important concern. Our allies in Europe right now, Germany is a specific example, are turning on coal plants. I mean, if we're so interested in being green, we know that natural gas is better than coal, but Russia's no longer going to be supplying it. And so as allies who have more natural gas than anyone in the world, my question is, when do we change course on policy here at home? When do we begin to pump again? When do we begin to bring these specific jobs back that can ultimately make a difference in people's lives? Because those are really good jobs, and crude and natural gas are selling at very nice prices right now. So it'd be nice that we got the wealth as opposed to exporting that to other nations.
Yeah, we're going to need a new administration for that and the lowering of restrictions as well. All right, so the so-called Inflation Reduction Act passed in the Senate. It goes to the House. They're going to vote on it Friday. If that passes, what could that do to inflation?
This is probably the worst recipe, personally, if you ask me, for inflation. I don't know how it addresses it. Higher regulation, 87,000 new IRS agents. By the way, I looked it up. There's only 75,000 branches of banks nationwide. So that means more than one IRS agent. That's a new one, by the way, still the same ones that are existing per person here. So this is incredible. This is Build Back Better light. And, they were looking before at monitoring everything for $600 and up for transaction. I don't know why the Patriot Act does $10,000 and up if we're looking at $600 and up. Are the billionaires and the big corporations really the ones that are, dodging all these taxes, that we need 87,000 new IRS agents? No, I don't think this helps inflation at all. If we were doing things to increase supply and supply side economics, that's what's worked. That's what will work right now. And that's what we ultimately need. The demand's so high, the supply's so low. So guess what? Price goes up. But when the supply ends up getting to the place that we know it can be, then demand, normalizes, and we ultimately have the opportunity to get back to more normalcy. But there are just so many crosswinds right now that to bring in a new $1 trillion worth of spending, guess what? When you spend, then that dilutes the dollar. Additionally, we're having the Federal Reserve to reduce by $1 trillion off their balance sheet here as we go forward. So we are going to be a lot tighter as a nation. There's greater regulation that's going to be coming. And again, this is where families need to sit down and they need to analyze where they at based on their time horizon. How much time do they have left prior to retirement? What should they be doing? And specifically looking at protected assets. Because if bonds today cannot hold their ground when interest rates rise, and also maybe they go from creditworthy to not as creditworthy if things begin to change more, we have some problems. And so we've specifically been planning for this. We've seen this coming for a long time. And ultimately, there are real solutions. But based upon the individual and who they are, you really need to sit down and evaluate, individual selections, the type of portfolios. To use another football analogy, if I'm on my 5-yard line, I have a different strategy than if I'm on the 5-yard line before I score. Those that are nearing or entering their retirement, I'm just going to encourage you, don't give in to FOMO. This is a rally. It's real. But there are always bull market rallies within bear rallies. We saw 6 in the .com, 5 in the 2008 market. And so there's times to make money. So understand that, on a watch, we have an hour hand, a minute hand, and a second hand. Short-term, mid-term, long-term. Very important that we understand what we're going to be doing here in the short term, but let's get our midterm and out-term outlook dialed in correctly. And let's make sure that we've got real strategies that are going to be there for us along the way.
All right, good advice. David Trzaski, CEO of Sound Planning Group. Thanks for your time today.